Everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. Jace, it's exciting to be here for another week as the markets, everything's happening once again. Trump is causing all sorts of ripples. Yes, how are you today?
Yeah, hey Rog, I'm good. I'm good. Yeah, it's interesting, isn't it? Whole lot of activity. Everything's all quiet, and then just takes one comment, it all goes haywire. So it'd be interesting to talk about that through the show today.
Yeah, I think people woke up on Monday or maybe Saturday morning and saw, Jesus, it's been a while since we've had this big drop over in the US markets, right? So it hasn't really affected us too much here, but things are starting to go down a little bit. But yeah, it'll be interesting to go through. We've already got plenty of people on chat ready to go, which is great to see. Welcome everybody there on the other side of the line there. We've got a general show today. We're going to go through the markets once again. It's the Aussie market, the US market, and the Hong Kong market and the Chinese market. And they're the ones that we offer at Selfwealth, right? So, and then we're going to, if there's any general questions, we'll try and pop them in there. But because most of this show is all about your tickers, right? We want to have a look at the tickers, the suggestions that you guys come up and see what we think about it from a technical analysis point of view, or our technical analysis point of view, one that I've certainly adopted the last 2 years, and that's actually Jason's technical analysis point of view, because he's the master in the room. He's the one that's been around for 30 years. And I'm proud to say that over the last 2 years, I've finally found a system that I'm quite confident in as well, in that motion trader system that Jason runs over at motiontrader.com.au. All right. So anyway, Jace, how are you? I've already asked you how are you. Let's get into that disclaimer, and then we can get into the show, right? So.
Yeah, so quickly into the disclaimer. So everything we do today is general personal advice and anything that we say, and this just goes through that. I'm also not part of Selfwealth. My business, as Roger pointed out, is Motion Trader. So my details are at the top: licensing, general commentary, etc. Beneath there is a Selfwealth disclaimer. Same thing: licensing, general commentary. It is all in there.
Yeah, fantastic. Thanks, Jason. As you can probably tell, there's not much planning that goes into this show other than what Jace does. He does a lot of his planning throughout the week, and he's got some amazing material outside of this show. So that's why I've always encouraged people. Now people starting to ask me as well as I'm getting results. Like, what do you learn? How do you learn? Well, then I can say that I've done a lot of learning over the 10 years, but I think in the stock market game, 10 years that I've been in finance, basically. In this stock market game, I think I've done the majority of my learning has been consolidated now through the 2 years that we've been doing this show, Jace. And it just takes a really simple system, you realize, to have a growing portfolio. So that's something that I'm proud of, but I'm also very thankful and grateful to have started this with you and to be able to impart this knowledge to our clients at Selfwealth, or to your clients, Jace. Once again, I can only sort of highly encourage you to go to Motion Trader. So that's what the show is also about, looking at your tickers. Obviously, we're going to look at one of your tickers each. So even though if you've got two in there, I'm just letting you know we'll probably just end up going through one. All depends on gauges. We'll gauge to see how we go. Obviously, if we can fit two in, I'll circle back to your other one. But yeah, feel free to put them in, and then I'll draw a line in the sand when we can't handle any more tickers. Okay, I think there is one more thing I forgot to say. At the start of this month, we did start an offer. Obviously it was for 20 free trades, valid for new portfolios, one new portfolio. That is still available for new portfolios. So if you want to open up an account, there's a link below. Right, if you're not an existing Selfwealth client, there's a link below. You can click that link, start it up, and then you can email sales at selfwealth.com.au. This week's code word is Munger. So that is Warren Buffett's partner, obviously, in crime. Back, obviously, he's passed now, but great investor of the day was Charlie Munger. But this week's code word is Munger. All right. So if you want to take advantage of that, email that code word to sales@selfwealth.com.au if you're a new client and want to open up a new portfolio. We did have it available for existing clients, but that offer's been exhausted now. So we've been able to give all those out. So thank you for that. And that's valid until the end of October. All right, Jace, I think I've done my part for now. Let's get onto that Aussie market.
Okay, so we'll kick off with the ASX ASX 200. And, well, yeah, some big headlines and some big moves on Friday in the US, but so far, the local market is holding up pretty well. And you can see that the pullback has already been finding some support around the 50-day moving average, and of course beneath there we have the 100-day moving average. I'm viewing this as a consolidation within a bullish trend. We've discussed the possibility that prices could take several weeks to consolidate. We've done that over previous shows, and I think that's what we're seeing now. I think this is an ongoing consolidation. One of the scenarios we've looked at previously is whether we could get a sideways compression like back in mid 2024. You can see the market had a good run above the moving averages. Then it paused for around 3 months. We got this sideways movement around the moving averages. That's certainly one of the possibilities that could develop around where things are now. This period here will certainly have its own unique form, but I think that some sort of sideways consolidation along the moving averages is entirely possible. Maybe over the next few weeks. Despite the headlines that have come out and all the nervousness around some of the price action, the underlying structure here remains positive. We've got the moving averages, the 50 and the 100-day moving averages, where they're continuing to rise. Price being still above the moving averages, and that well-established sequence of rising lows, rising highs is all still in place. So those are, of course, all bullish markers, and I think they continue to set up a bullish backdrop. I don't think we need to predict exactly the course of what the market's going to take over the next few weeks. And of course, the thing is, like, no one knows that. Like, people can say what they can predict this and predict that, but none of us actually knows what's going to happen. I think it's more important. I think it's more important to be able to assess the overall structure and then position a portfolio accordingly. And I think if you can do that, it helps avoid all the day-to-day decisions and fear that comes out around these news reports that we've seen on Friday in the US. I think this consolidation could persist for a bit longer, but that dominant upward trend, it does remain in place. So that's how I'm positioned, and of course, using those wide trailing stops to manage risk. If things do at some point start to deteriorate and start to decline, that's what the trailing stops are there for. So it removes the guesswork of what to do. It's having that plan to be able to navigate this no matter what happens. Stay in whilst the market is holding up and hopefully moves higher. But if it does turn, well, that exit plan helps then protect capital.
Fantastic. I was just wondering, Jace, do you use any sort of oscillators at the moment? Because a lot of technical analysts will probably look at this and go, well, maybe it's starting to form a double top now. Do you use any of these oscillators at all to maybe see the probability of that happening and coming forward?
I'll look across various indicators at different times. My main go-to is the moving averages and where the price is relative to the moving averages. So look, there's not like one go-to oscillator which I say, look, you got to keep an eye on this. It's my other indicator viewpoint will vary through the market cycle depending on what's going on. I think keeping it simple. I think removing complexity by resisting the urge to overlay a whole lot of indicators, and just understand your structure. Moving averages are up, prices above moving average, balance of probability favors the upside. I think that's the best way to do it. Like, people saying, oh, look, is there a double top forming? Well, anything could form, but whilst we've got that overall bullish backdrop, I think the odds favour looking for opportunities on the long side or positioning for a potential extension of this bullish trend at some point, but of course then managing risk. Trying to pick tops, I think, is I think it's the wrong play. I think the play is going with what's working. What's been working is the upside.
Yeah, it's fair enough. All right, let's be a bit more of a drop in the US market. So let's just have a look at that one.
Yes, over to the S&P 500, and periods of calm like we had last week. Well, they often lead to bouts of activity, and that's once again proven to be the case with Friday's 3% down day. And while it was a scary headline-grabbing decline, like 3% in one day, that's the largest one-day drop since back I think in April. It's like it certainly grabs the headlines, but it doesn't change. It doesn't change the underlying trend. So far, all we have is a pullback to a rising 50-day moving average. And both the 50 and 100-day moving averages, for that matter, both continue to trend higher. From that perspective, I'm viewing this as a pullback within a bullish market. But I think there's a probability of more consolidation to come. And maybe we could see several weeks of consolidation around the moving averages. We could see further back and forth volatility for the rest of the month potentially. But then that could then lead to a platform around the 50-day moving average, which then could lead to higher prices into year end. So all sorts of ways this could work out. But at this point, that underlying bullish structure remains in place. I'll show you why I think the odds favour consolidation in the near term. Just coming over to the equal weights, we're looking at the S&P 500. Now let's look at the S&P 500 on an equal weight basis. And this is something we look at we look at this quite a bit. I think it's useful to look at this as a gauge of the broader market, not just the S&P 500, which is dominated by those big tech stocks. So when you look at this, and I was talking about this in my strategy session last Friday, which I do live at 1 o'clock, and the equal weight has mostly been trading sideways for about 7 weeks. There was a short-lived break to the downside in late September, and then there was a break to the upside in early October. But then look what happened last Thursday. So forget about Friday for a moment. Just on last Thursday, you could see prices coming back down below the breakout point. So prices, let me just put a marker on. See, prices broke higher the early last week, and then on Thursday they were coming back down below the breakout point. And it's an interesting thing when that happens. That's what we then call a false break. And now that was before Friday's sell-off. So I don't think this false break by any means predicted what was going to happen on Friday. I think that just took pretty much everyone by surprise. But what I said in Friday's strategy session was that it was a sign of a market that wasn't ready to move higher and that more consolidation was likely for the broader market. And I think that's what we're seeing now. I think we're seeing that consolidation within a bull market. There's nothing here to suggest stocks have made a lasting high. Not in my opinion, anyway. I don't think there's anything there to suggest that a lasting high has been made. From where I stand, it's I think the underlying upward trend remains up. I think the way to play this, it's staying long stocks, using those wide trailing stops we were talking about when we're discussing the ASX to manage risk. And if prices can stabilize around these moving averages, well, then that could set up a new opportunity heading into November, December. Bit of price action is needed before that's jumping ahead a little bit, but it's but nonetheless, that's what I'm looking for. I'm looking to see whether we get that price stability around the averages, and then that potentially sets that platform for another run.
Yeah, fantastic. I think we're all looking for that now, Jace. That stability around those moving averages.
But it's interesting. On Saturday morning, I had an email came in. Just a punter who's not not part of the motion trader service, just seeing the replay of my Friday strategy session on Saturday, just saying, oh, market's going to crash. It's like, yeah, I think a lot of people have been this whole way up, have just been saying this rally can't be real, it can't work like that, this and that and whatever else, market's going to crash. It's always the way. There's always people looking for crashes, but I think there's been a lot of nervousness around this rally. It hasn't been what I'd call a euphoric rally. It's going to be interesting how this plays out, because there are people out there thinking, well, okay, this is the first drop, and they're waiting for like the big hit. I don't know. Maybe it happens. I don't. My feel is it won't. Of course, I don't know. I think we had the big sell-off in April. I don't think we get an encore of that at this point. Anything's possible, but I'm still playing this from the long side. But of course, always managing risk, having those exit points, and not getting overconfident about anything, because things can change.
Of course, and it all depends on what on these. Obviously, on our politicians a little bit, because China was involved in all that on Friday and Saturday. How has it affected the Hong Kong China markets?
Yeah, well, going over to Hong Kong first, and the Hang Seng, and the theme of pullbacks, it continues over in Hong Kong. At this point, I think it's just that. I think it's a pullback. The overall structure remains positive. We've got these rising moving averages, and remember that within just about every bullish phase, there's going to be sharp retracements that tests the resolve of those who own shares, and I think this is one of those times. For me, it's a case of staying with the incumbent trend. The incumbent trend is to the upside, and doing that until there's good reason to do otherwise. At this point, all we have is one sharp down day. That's not enough to end a trend. Going over to China, the Chinese market, same goes here. So far, it's one down day, and that doesn't alter the structure that's been developing over many months now. What's important now is what price action follows this downward move in prices. It's like, do we get the consolidation around the moving averages, and then start to see that the dip is being bought? And I think that's what I favour, because that's the sort of price action that typically occurs during bullish phases. You get the pullbacks to the moving averages, you get the consolidations, and then from there you often get the rallies. On the other hand, if prices were to crash through last week's low, well, then we probably need to reassess. But for now, I think that this larger basing structure that's formed over a couple of years, and this developing trend, I think they remain in place. I think that remains the main focus, not one down day.
Yeah, some great points in there, Jason. And obviously, when if it were to go south, just like it did in April, May, we were prepared there, and we sort of saw it through. And for now, it's going okay. But let's get on to the next viewer question here, and I think it's good because we're just going to get straight onto gold. The question from Koala: interesting thoughts on the gold prices. Many of their stocks have gone up, small cap stocks, with the current share price.
Yeah, well, here's the gold price here, and it's I've been surprised at how far this has rallied in the last 3 months, and how strong it's been. It's the unsurprising part was we had a 3.5 month compression along the moving averages, and then we got a breakout in late August, and it's no surprise that we've seen a strong rally from there. But just the persistence and the consistency of it has been, I wasn't expecting to see this size of this stronger move over a relatively short space of time. Gold's actually up over 50% this year. And I think it's only the second time in the last 40 or 50 years or something that it's been up that much in a within a calendar year. So it's been an extraordinary move, and I think this is why I don't use profit targets when I'm investing in markets. It's let the trend surprise you on the upside. So if I was a profit target sort of guy, I probably would have been locking in some profits as prices like started to get a bit stretched in mid-September. But let profits run, see where the trend takes you. I think that's always that's my that's the way I'd typically approach a market. And at this point, this trend remains strong. It remains up. It's historically stretched from a number of perspectives, but that just because something's stretched doesn't mean it can't become more stretched and move to even higher levels. So I think there's two important things here. Firstly, it's like for those who are on the trend, I think the consideration is to staying on the trend. That's what's been working. That's where the money's been made. For those who aren't on the trend and who are now just realizing gold's been going up, I think it's another situation altogether. I think risk is elevated in terms of buying or establishing new positions at current levels simply because it's been such a big run. Gold's notorious for having strong runs and then having sharp pullbacks. And like here, you can just see one from April, strong run, and then there was a sharp pullback to the moving averages. Gold will revisit its moving averages at some point. We just don't know when and from what level that's going to be. So I just don't know that this is an asymmetric entry point at current prices, at current levels for gold. And when I say asymmetric, I mean like, how much are you going to risk and how much do you think you could potentially make? And like to enter at such an elevated point, I think you need a much larger initial stop, and the whole dynamics of the trade becomes less favorable, I think. So for me with gold, it's hold on for the ride, see where it goes, but if there's substantial profits there's never anything wrong with trimming some off the top if a portfolio is becoming gold heavy, just simply due to the significant rises. There's nothing wrong with doing some reweighting and trimming. I think that's generally a prudent thing to consider. Generally letting profits run, letting what's been working continue to work, but being careful around new entries and getting overconfident after a big run.
Okay, fantastic. Let's have a look at David. PPM, thanks for a great show. No problems. PPM is his ticker for 62 trading days, up 1% over that time. I'm thinking the capital could be better deployed. Thoughts, please.
What was that code again?
This is PPM.
PP, right, PPM. Well, this is not doing badly at all. It's it's a stock which has been down and out for a while. Has it formed like a big base down through, like you can just roughly draw this in. You can see it's got this big sideways basing phase. It's broken out. Moving averages are rising. Price has been above the moving averages. It's had a good run. It's come a bit stretched and it's pulled back to the averages. So there's nothing wrong with the price action there. So stocks that run do consolidate. It's all part of how it works. So like for instance, we could get a period where this just where you get a bit of sideways price action, then it starts to build again. Like who knows what it's going to look like, but something like this could form where you get the sideways along the moving averages and then you start to get the lift off again. As being one part of a portfolio, I'd be happy holding it. It's like I wouldn't have just PPM in my portfolio. It would be there, like it's not in my portfolio, but if it was, it'd be like one of maybe 40 or 50 or 60 or something stocks. So it's okay if it wants to have some quiet time. It can do that. Particularly if I'm in from a good level. So there was a motion trader signal for this stock. It probably would have been around May. So the moving averages have crossed. It's hit a 70-day high. So there's probably a signal around May. if I'd bought around then, yeah, it's okay if it's rallied for a bit and doesn't do much for a few months. I can collect the dividend while I'm waiting, assuming it pays one, and then potentially get a larger move later on. Yeah, look, I think part of capturing big trends is being patient. You've got to sit through the periods where they're not doing very much, and just about every big trend will have those periods where it might be several months. Like just look at look at gold. We could have said bought gold in May and gone, oh look, this is this May and it's June. Now we're into July. We're heading into August. This is just doing nothing. Look, it's just going sideways. Let's go and do something else. And as soon as you do that, the quiet period ends and the excitement begins. So we don't know whether PPM will do that, but don't get impatient with your stocks which are in profit. Give profitable stocks plenty of time to do their thing and let big trends potentially develop. That's where the money's made. Jumping from this to that to something else, it's like then gets very hard to get those big triple-digit gains because you're always jumping every time there's a pause in the trend.
Yeah, that's some good points there, Jace. All right, let's have a look at Marcel's PRN, please.
Look, trend still up, strong trend, shallow consolidation. If I had this one, I'd be staying on it. I'd probably be struggling to buy it at this point because even though it's having a shallow consolidation, the moving averages are catching up. It's still a fair bit above the averages. I'd probably rather let it consolidate more and then maybe consider it as an entry. But if I was, as I say, if I was on board, I'd be staying on board. It's a motion trader stock. It's been a motion trader stock for a while. It's like, there were good entry points earlier in the year, back around May, as prices were like lifting out of this corrective period. And then, there's more entry points. There's another consolidation back to the average. Like we were talking about PPM a moment ago, like maybe this is its PPM equivalent where it had run, started to come back, then starts trading sideways, and it can do nothing for a few months, and then it can re-engage in the upward trend. Look, I'd be happy staying with this one, letting the profit run. Always using those trailing stops. So my stop would be back below the 100-day moving average. There's a calculated motion trader stop for it. I don't know where it is offhand, but it would be almost certainly below the 100-day moving average.
Yeah, giving it plenty of room to move, obviously. So,
and that's just such an important part of it. It's like if I get pushed back on one thing more than anything else, it's wide trailing stops. I had a guy left a comment on a YouTube video over a weekend about wide trailing stops. He said, it might work for you, but I'm thinking of using a 20-day moving average as my trailing stop. And it's like, what? And he said, it was a comment on a video about wide trailing stops, and he said, "What do you think?" And like, I can't, like, if you watch the video, you know what I think. It's like if you want to use a 20-day trailing stop, let's just put one on here. I'm not sure how this is going to look. Might actually work on such a strong trend. Yeah, so 20-day trailing stop. Look, you're getting knocked out all the time. This is a strong trend, and a 20-day trailing stop can't do much more than say we buy on the breakout and we sell there. So we've picked up, good for us. We've picked up an 8% move if you get it smack right. And look what you could have done if you'd got a wide trailing stop from the same entry point. Maybe you're up 70%. So forget really, unless you're really short-term focused and you're highly skilled at what you do. These close trailing stops, it's really a mug's game. Only very few people can, I think, work around such tight parameters, and they've got to be watching the screens the whole time. It's not what most of us do. Most of us do other things as well. wide trailing stops, give them plenty of room to move around and stay on large trends for maybe 1 to 3 years. It's not meant to be an excitement generator. It's meant to be a money generator. So give them room, give them time, accept that plenty of stocks won't do anything spectacular. But when you do get on the good ones like PRN, just maximize that gain as much as possible.
Yeah, I think it's. I mean, I even in my past, before I met you, Jace, I probably dealt with those tighter stops as well, right? And now I think back, it's a lot more work, right? And 20-day moving average, it looks fantastic when you put it on just then. When the market is booming like this, and in general, you got a lot of stocks in your portfolio that are just going up in one direction. They might work really well, but in a regular everyday market, and you don't want to be looking at the screens in day trading, then it will certainly knock you out a lot more if you're paying a lot in brokerage, right? So, but look, everyone does their own thing, and we're not telling you we're the only way to do it. You can go ahead and give it a shot as well, right? So using a 20-day moving average, but if it's more longer term, mid to longer term is what we do, I guess, and staying on those trends a lot longer. I've found this system that we do and we teach you to be are really good. So, all right, let's move on to Claudette's NMR, please.
Sorry, what was that, Rog?
NMR. N for Nelly, M for Mary, and R.
Well, this is a stock which has lost its momentum. Well, like we talk about this quite a bit. Low price stocks, they're great in that they can run. They can, a 2-cent stock can become a 20-cent stock, and that's a huge gain if you can get that. And that's kind of what this one's done. It's gone from being a 2-cent stock to a 22-cent stock. Now it's coming back, and that's a really nice upward trend. So it's one which is completely tradable and able to stay upon. But then, a lot of these smaller price stocks, those trends then deflate. It's like we don't know which ones are going to become enduring and really turn into something big, and which one's just going to give it all back. So this is where, like, just having those trailing stops. If I'd bought that, let's put a trailing stop on and see how it actually looks. So this is a type of trailing stop I would use. And look, it's giving it a bit more room. This is a 10 ATR stop. I think that's probably reasonable. Like we've talked about in the past, if on these low price stocks and they're running, scaling out, like once you're up 300-400%, I think scaling out like could be selling a fifth or a quarter or a third, something like that. Just banking some profit can be a good idea, because they inherently need wide trailing stops, but then we know that a lot of them do come back down and trigger those wide trailing stops because they don't become enduring trends. So I think scaling out can be a good strategy with the low price stocks. Then using in conjunction the wide trailing stop for the balance, that would be staying in this stock. What I'd note at the moment is that the structure is no longer working in the stock's favour. So the moving averages have crossed, and we're now getting these consolidations below declining moving averages. So there's a layer of vulnerability which is now in the structure. I wouldn't be buying or averaging down into this stock at this point. I'd need to see it back above the moving averages to consider any more buying activity. But I think today's price action is interesting. That it's open near its lows and now it's up near its highs. So together with that trailing stop we just saw, which came in I think around 8 cents, it's like somewhere between today's low and 8 cents is probably where I'd be saying, look, enough's enough. I'm going to rule this off and move on. But at the moment, if I was in from good levels, I could stick with it for a bit longer, but certainly not a buy at this point.
Okay, fantastic. Let's have a look at the next one along here, which is Mix SVL, please.
yeah, this has started to lift off nicely. Yeah, this is one I'd be staying with if I was on board. You can see there was a resistance point through there, which it broke higher from around last month. Been several like nice rallies back to the moving averages, rally back to the average, rally back to the average, big acceleration. Been some consolidation in the last few days. Silver's hitting new highs just round about now, like on overnight in the US trading. Silver was at new highs, I think, as was gold. Actually, here's silver here. Just a quick look at it. Yeah, so there you go, silver at new highs. So I'd be staying with SVL at this point. Do you the trickier question? I think the easy question is staying with it, particularly if in a good level, then we can give it lots of room to move around. The trickier question is, do you buy it at current levels? I think that's a harder question because it's elevated above those moving averages. So that kind of needs like around a 30% stop loss just to get below the 50-day moving average. So I'd be inclined to, if I wasn't already on it, I probably wouldn't make today my buying day. I'd just go, and with what I was saying about gold earlier, silver's in the same boat in that they had big runs. I'm just wary around putting new money into stocks which have run hard, into sectors which have run hard, but very happy staying on board a stock like this if I'm in at a good level.
Okay. Mohammed, hello. Let's have a look at his LYC, please.
Well, this has been going gangbusters and new highs today. I'd be staying on the trend, letting it run. It's like how this has turned around. For a couple of years we talked about the potential of a basing phase going on, and then the structure starts to improve, gets above the moving averages. We start getting breakouts. It was a harder one to get on board because these had some big pullbacks. As it was trying to gain that momentum. That's why we use the wide trailing stops. It's a motion trader stock. Motion trader's entry was, I think it was back in around this time last year when it started to break higher, and went through a difficult pullback heading into early this year, but the wide trailing stop stayed in, and now the wide trailing stop is trending higher. So it's a motion trader stock. If I was on this one, I'd be staying on it. I'd be letting the profit run, but I'd be careful around buying it. Actually, well, I wouldn't buy it at this point. One, it's stretched above the moving averages. Two, it's a rare earth stock. Rare earths are in the news at the moment as part of Friday's turmoil. So you get a news headline, and maybe rare earths quickly come back to the moving average. It's like I think it's a riskier play to be getting involved, but it's a play which I'd let run. If I was on board, my trailing stop would be back below the 100-day moving average, giving it lots and lots of room to move.
Okay, I think that sort of answers your question there, Koala, which I assume RE would mean rare earth. So let's have a look at Dr. Cyber, I think it is. SS1, please.
Yeah, well, this is this was actually, I actually saw this on the news last night. It was on the ABC news report. I think they've got some sort of a silver find in maybe in Nevada or somewhere in the US. If it's the same stock, I think I heard about. So look, it's rallying off the moving averages. It's breaking to a new high. If I was on it, very much I'd be staying on it. Is it a buy at current levels? I think it probably needs a 25% stop at the moment. It's possible. It could be. I think it's a higher risk play for all the reasons we've discussed earlier. But as somebody was looking at a silver stock, I think this is a potential buy. I think it's 25% of risk to get below the moving average, to get below the low from a couple of days ago. I think there's been an announcement around some sort of a fine. So you've had that initial run up. So this can go a couple of ways. You can get that initial run up after an announcement, and then you can get some consolidation, and then you get another round of buying. So yeah, I think it could be worth considering it at current levels. It's it could be an interesting way into the silver space. So definitely a stock I'd be holding. Could consider it as well.
Okay. Hello, Ostaxstar. Let's have a look on ASB, please.
Trend's still up. Getting a bit of volatility within the trend, but the trend is still up. If I was in this one, I'd continue holding it. Wide trailing stop. It's a motion trader stock, so there's a calculated trailing stop on it. I wouldn't be buying it at this point. I'd want to see the share price stabilize, and it has been a big run, up from like 250 this time last year. So yeah, I think the key now is I'd want to see it stabilize maybe around the moving averages. Nothing to say this trend can't extend higher, but I think it needs that pause, and that's probably going to take some time at best. Nothing to say that it won't. It's not topping now, and it's going to the structure is going to change, but we don't have that. We don't have that evidence to sort of like point to yet. It's still above moving averages. If we find the price continues to decline and then it starts consolidating below declining moving averages, it's another story. But we don't have that at this point. For now, it's like we've seen before, pullbacks to moving averages. It can be sharp at times, but as long as it can start to stabilize near current levels, I think we work on the basis the trend remains up.
Okay, fantastic. The next one's VAU.
Trend up. I think it's gold orientated. This stock. I wouldn't be a buyer at current levels. It's well elevated. All the things we've been through previously. But if I was on board, I'd be staying on board. It's a motion trader stock. I don't have it in my own portfolio, but it'd be nice if I did, but I don't. You can't have everything. You don't need to have everything. Just need to have a nice wide sample of stocks and let the good ones run. And this at this point is a good one, and I'd be letting it run.
All right.
And wide trailing stop. It'd be back below the 100-day moving average. The stops are always going to be wide. I think they particularly need to be wide on these more volatile stocks, because they do have those shakeouts, and you want to try and see off the shakeout and stay on that longer trend. Or at least that's what I want to do.
Okay. Let's look at PLS, please.
Yeah, well, you can see that the structure has been changing in this. This has been like down and out stock for a couple of years, and we've finally got this shift from below the moving averages to above, and it is making its way higher, and it's pulling back to the averages. And every time we get these pullbacks, there's another round of buying that comes in and supports it and pushes the price higher. It's one of the most shorted stocks on the ASX at the moment, I understand. So if some of those shorts decide at some point they need to cover, that's certainly fuel for an ongoing rally. I had some of this, but when did I buy some? I bought some just as prices had broken higher, but then I just shut down some risk when prices came back to the moving averages. It's all hindsight. I should have held on for a bit longer. But I had a collection of them. I had Chalice, Lion, and PLS. And was there a third one in there? I think there was a fourth one in there as well. So I've still got Lion and I've still got Chalice, but I let go of some risk on PLS. So you don't get everything spot on. If I hadn't sold when I sold, I'd still be holding now and just see whether this trend can continue to build. It hasn't. I'd still call this a developing trend. It's not really established yet, but it's getting there. I think one to hold, see if it can continue to gain momentum. In terms of buying, like I'd probably like to see, like, we got a bit of a consolidation, and the it's all a bit messy in there. If we got a bit of consolidation, the moving averages started to catch up. Yeah, look, there could be an opportunity develops. I'd probably leave it for the moment if I wasn't already in, but I'd happy to hold if I was on.
Okay, fantastic. Just thought I'd just give you a break, Jace, and just let you know that there's a couple of people that said they've sent some emails in a couple of weeks ago around the offer. Send in an email to sales@selfwealth.com.au again, please. And I will double check if I can find the one from 2 weeks ago to see if that's the case. All right, so apologies if it was missed. Feel free to do that again. Don't forget to like and subscribe on the show as well. And don't forget to also put your comments in after the show. We'd love to see those comments. If you've got any questions, we can always circle back to them next week. All right, let's have a look at Devenders then, please. Can we have a look at Rio? Thanks.
Yeah, it's I think I think mining generally, I think that's like the small miners have really been flying. Well, some of them, of course, not all of them, but there's been a lot of strong gains in the small to mid cap miners. I think the big ones like BHP, Rio, and Fortescue, I think they're looking really interesting. I think Rio could be on the verge of moving out of this 3.5-year range. I've got some Rio. I'm happy holding it. I like that the moving averages is trending higher. I like the share price is becoming more established above the averages. Rio probably looks the strongest out of Rio and BHP at the moment. I think Rio is looking the stronger of the two. Look, I think this is an area worth considering. If you like to have exposure to the big mining companies, this could be a time to be looking at getting some exposure. It's had a bit of a run. Whether there's going to be a bit of a consolidation, that's always a possibility. If I was on board, I'd be staying on board. I am on board, so I'm staying on board. If I was looking to get on board, I guess I could get some at current levels. Look, probably even like a 10% stop or something would probably work. You're probably not going to get the same movement as you do with a small to mid cap stock, but the level of risk is probably lower as well. So an interesting play, I think.
Okay, thank you. Alessandra, hello. Let's have a look at VGS, please.
Yeah, well, this is continues to trend higher. If I had some of this, I'd be happy continue holding it. It's being positioned long equities has been the play, and this looks like a good way of doing it through this Vanguard International Shares ETF above rising moving averages. It's for those who don't necessarily want to do all, like, a lot of people have mixed. Some people would like, and I do myself. I'll have some index ETF, and then I'll do a lot of individual stocks locally. And this can be a good way to get some of that international exposure. So it's, for me, it'd certainly be a hold if I was in it. If I was just wondering about would I consider buying it now? Like, given I'm thinking the markets look like maybe there's some consolidation, I could probably just wait just watch it for a week or two, see whether there's a bit of consolidation. But yeah, generally, I think it's probably a worthwhile consideration for someone who just wants that international share exposure.
All right, fantastic. The next one is EUR, please.
Well, hasn't that taken off? Yeah, it's well, yeah. This is why we don't use profit targets, while we stay on trends. And another example, I'd be if I wouldn't be buying it now, because I just don't know how I'd manage the risk around it now. But if I was, it was a gettable trend if you were if you were onto this one. And just keep going back and looking at the price action. Here you could see it building above the moving averages, then it consolidates, comes back to the moving average, and you lose the scale on this so quickly. You can just see where it's powered higher. So you could see it rallying off the moving average. So there was a buying opportunity just as it rallied off the moving averages, and then the next day that's when it really started to rocket up, and your opportunities for getting in become quite harder. But yeah, look, I'd be letting this run and see what happens with it all. But it's not one I could consider buying at current levels, because it's too hard to manage the risk around it. But well done for anyone who's on board.
All right, good one if you pick that one up. Let's have a look at the next one, which is KCN.
Trend is up, averages are up, prices above averages, probably a bit stretched above averages as well, for that matter. But this is a boom we've had in these small to mid cap miners over the last couple of months. If I had it, I'd be letting it run. That's been what's been working. I'll be giving it room to move around. My stop loss, trailing stop, it's possibly a motion trader stock. I'm not sure. It meets most of the criteria, just whether the volatility filter may have stopped it coming into the portfolio earlier on. I'm not quite sure on this one. But below my trailing stop would be below the 100-day moving average. And let it run. Wouldn't be buying at current levels. It's run too far. It's too stretched. That doesn't mean it can't continue to run. It just means that the risk reward is not as favourable as I'd like to consider a new entry point. But trend remains up.
All right, 29M.
A potential emerging trend. You can see the structures flip from below to above the averages. We've had the averages cross the initial consolidation and rally off the averages. I'd be staying on board if I had some. If I didn't have some, I'd probably just watch it here, just see whether we get a bit more of a consolidation. Could it could we see it make its way sort of a little bit more sideways, and then start to get another lift off. It's like you never know what the price action is going to be, but I see structures that kind of look like that quite a bit. So that's why I sort of like my default for a consolidation to the moving averages. Would we buy it at current levels? It's starting to need maybe 30% of risk. I'd probably prefer not to buy it now. If I didn't buy buy it as it was breaking higher, like some of these earlier points, I'd probably leave it at the moment and see whether we get a consolidation which provides that entry platform. But if it was already on, great. I'd be staying on, wide trailing stop.
Okay. Hi, Jennifer. Thanks once again. Is it too late to get onto this rare earth play? ILU, it's another one.
Yeah, well, that's really That's kind of what I was talking about just a moment ago with 29M, where it gets a pullback to the moving average, and you get that sort of like consolidation, then you get the breakout. So there's an example of how a consolidation back to the moving averages can look, and then continued rally. I think the time to have bought ILU was probably up until say the 3rd of October. Just as we had this consolidation, then prices start to break out on the Thursday, and they ran again on the Friday. That was probably the time to buy, possibly the Monday morning. And then they start to just get away a bit and start going, well, it's now I need a bit more of a stop. It's probably, for me, it's probably not a buy at the moment. I think the buying point, as I say, it was a couple of weeks back. Now it's a case of holding what you have, potentially. That's what I'd do if I had some. I don't have some, but if I had it, I'd be very happy holding it. Wide trailing stop, and maybe see what it looks like on the next consolidation. Just looking at today's price action, it opened, it traded higher, it's all come all the way back. There's quite a bit of volatility within today's price action. So I don't think I'd want to step in and take on new risks now, but very happy holding positions which could have been, like, we got an entry signal for this back in August. Prices got above the moving averages, consolidated, and then broke to a new high. So there's some entries in early August. It's like just wait for the shot to line up. And then it was a case, okay, it's run a bit, let's watch it again. Then we get more buying opportunities. Just wait for the shot to line up and take it. But when it's not ideal, it's often it's best just to step aside and look elsewhere, or be patient and wait for that shot to develop.
Okay. Hi, Kirby. Let's have a look at RDX, please.
What was that?
RDX.
RDX. The potential for a trend is here. We've got a setup that could lead to upward, an upward trending period, but we need that momentum really to kick in, and that would be probably like even a break above Monday's high. Break above yesterday's high could do it. So we've gone from below the averages to above. We're getting the consolidation along the moving, just above the moving averages, and the moving averages have crossed. So, like, if we got, we could get some more sideways, which is then followed by the acceleration upwards. So that's the sort of price action I'd be looking for. That's a setup which I think is in place to potentially deliver. If I'd bought a little bit earlier, great, I'd stay in there. If I wasn't in there at the moment, I was just interested in the stock, I'd be inclined just to continue watching for now. Like, we do get a bit more consolidation in the markets generally. Maybe it can pull back and do a bit more work for a couple of weeks. And then, if it breaks above Monday's high, which looks to be around 295. So say we could set a buy order at 299. Like, I often would go to the other side of $3. So round numbers are a bit of a thing. People will put orders at, if they're people looking to sell, they'd look to sell at $3, or so having an order just above. But then it's probably thinking unnecessarily a little bit too much above in this case. If I were looking to buy it, I'd probably be happy to buy it around $2.99, $3, and see if it runs. We can manage risk around that. Stop's not too far back down to the 50-day moving average. I think it's a stock with potential and worth keeping an eye on.
Okay, good one. Next one's MI6.
Yeah, up and away. Two steps for an entry for me, but one I'd be staying on if I was on it. Harder one to catch this. You didn't get any of the consolidations once. Got above the moving averages and just kept going. I like it when we get above and we get this consolidation into the averages, but we don't always get that. But yeah, well done for anyone who's got on MI6. And yeah, look, I'd be seeing where it goes. But like, remember that one we looked at earlier in the show where it had that really nice early rally, and then it had the big pullback, was then below the moving averages. Keep that in mind. It's one of those lower price stocks where they're more inclined to be strong and then give a lot back. I'd be using a wide trailing stop. I'd be back down around the 100-day moving average. Like, it's not like it's gone from 12 cents to 35. So it's not like it's up 500% or anything at the moment. So I probably wouldn't even be scaling out of it. It's just like, well, okay, I'm just going to have a wide stop on this. And if my 130% gain turns into a, 30 or 40% gain, so be it. But that's how I'd probably play this one. Wide stop, risk giving quite a bit back, but trying to stay on the potential for a much larger trend should it develop.
Yeah. All right. Thank you. We've already looked at VAU. Let's have a look at FGG, please.
Yeah, it's upward trend. Yeah, I'd be happy staying on this one if I had it. It's not as spectacular as some of those mining orientated stocks, and that's completely fine. Yeah, look, it's just it's a steadily progressing upward trend. You can see why you need wide trailing stops on it, because it has these excursions below the 100-day moving averages at times. So if the 100-day moving averages you stop, it's harder to stay on board. But those wider stops that sit below the 100-day, hopefully can then see off the consolidations. Look, I'd just be happy staying on board. It's probably not one I'm overly enthusiastic about buying at the moment. Because I don't. It's not like it's just finished a consolidation or it's just rebounding off the moving averages. So it's not like there's a structure or an event happening at the moment that I'm playing off. So I'd probably not be necessarily a buyer at current levels, but yeah, very happy to continue hanging on to it.
All right, thank you. Hi, Dennis. Let's have a look at TGM. I don't like when they rally strongly and then come back quickly. I think that's a red flag for it. It's not one I'd be buying on this pullback. It's also, based on its name, it's also a gold orientated stock, and gold's at all-time highs, and this hasn't been able to hold on to its gains. So another flag for it. Look, if I had it, if I'd bought it before it had that, like if I'd bought it up at the highs, I'd probably be now saying, look, this is not working. I've got to just protect my, cut my losses. But if I bought in at lower levels, I could give this a little bit more time. But yeah, I'd be thinking about, okay, where do I want to say enough's enough with this stock? It hasn't been able to hold on to its gains. It's in a hot sector, and it's not hot itself. So yeah, I could give it a bit more time, maybe, if I had another opportunity which I really wanted to take and I needed to free up capital, well, maybe I could free it from a stock like this. But if not, yeah, look, there's nothing wrong with giving it a little bit more runway, but I think have an exit point in mind should it continue to deteriorate. Like, if it's coming back down into the 17 sort of region, back into where it had been consolidating previously, it's really just not a happening stock anymore, I don't think. So yeah, have an exit point in mind. It could fire up from here again, but I think it's always harder when they rally hard and they come back hard. It's just showing that there doesn't seem to be that interest in picking them up on the dip. That's a concern. You want the buyers to be lined up on any weakness to come on board. Doesn't seem to be the case here. Okay, thank you. Next one's BTL.
Yeah, trend's still up. Happy to stay on board. Rising averages, all that stuff. yeah, it doesn't stand out as a particular entry point, but yeah, look, certainly one I'd be happy to stay on board. Usual situation, wide trailing stop below the 100-day MA.
All right, fantastic. Mick says if the October finishes strong and polys keep relatively quiet, there's no reason for things it won't rally and pick up speed into the end of this year. Right enough. Well, let's hope so. Marlene, 4DX. Hello, 4DX.
Yeah, some big moves, haven't there, really, in the last few months? It has been extraordinary how strong the market's been. This isn't a resource stock, and big moves. I'd be happy staying on board if I was on it. Depending on where I'm in from. If I'd been buying at 30 cents and it's now up at $1.93, I might be. If I'd bought early enough, 380 odd percent, it's probably one of those ones I'd consider scaling out of, just to lock some in an extraordinary rally. You can see this stock's had extraordinary rallies in the past, and then it hasn't kicked on. It's come all the way back. That's why, with these lower price stocks that fire up, I'm more inclined to scale, skim some off the top, rather than probably scale out. Scale out mightn't be the word. It's skim some off the top, because I'd always hold a core position. I wouldn't sell the lot without a trailing stop triggering. But yeah, I'd be happy to stay with it. Certainly not a buy though. Not at these levels. Not with it so stretched above averages, and just not with a bit of earlier form on the board of having exciting rallies that it gives back. Doesn't mean that's going to happen this time, but I think caution would go to too much. I'd be too cautious to buy it at current levels, but happy to hang on to a core position nonetheless.
All right, fantastic. We'll do a couple more tickers for today, and then a couple of general questions in there. We'll finish off on Jay. So let's have a look at NWS, please. Just crossed 100 above the 50, which in the last few cycles indicates a low. So.
Actually, I'll look at the sorry, what was the rest of that, Rog? I missed that.
NWS, so the ASX one, I'm assuming, but just crossed 100 above the 50, which in the last few cycles indicates a low.
Oh, okay. Well, it has bottomed out around similar conditions in recent times. But look, I wouldn't be a buyer at current levels because it's below moving averages, which are declining. So it does add vulnerability to the structure, and that doesn't mean it's going to collapse, because as our viewers noted, it's like as when these moving averages have crossed to the downside, it's actually formed lows and rallied. But nonetheless, it's not a buying signal when that happens. It's a sign of vulnerability. What I'd want to see with this would be want to see it stabilize and then flip back above the moving averages, and then I could look at it. But at the moment, I'd just be cautious. If I was long, I'd stay long. It's a motion trader stock. There was a signal for this. It was a while ago. It's probably back in 2023, and it's been a long position. It's done really well. Wide trailing stop. It's still above a calculated wide trailing stop, so I'd be happy holding if I was in it. But before I buy it, I want to see it stabilize and flip back to the other side of the moving averages. We could end up with a sideways trading range, which then resolves to the upside in the months ahead. But as a general proposition, I don't want to buy stocks when they're on the wrong side of the moving averages. I want them above. I want to go with the momentum, not trading against it.
Okay, fantastic. Well, let's finish up with FMG as the last ticker, please.
So I've got some of this myself. So it's got this resistance point through here. Been watching. Yeah, look, it's just building along the moving averages. The moving averages are trending higher. A dividend's come out of this as well. So this drop down here, that's the dividend payment. I can just like adjust that and put the dividend back in. It makes this consolidation look better. When you adjust for the dividend, you can see it's really just it's had that strong run, and now we've got a sideways move with the moving averages catching up. So just take the dividend back out again. And so look, I think this is building, as we discussed with BHP and Rio as well. Looking at the, it's interesting to look at. I'll just quickly show you the iron ore price. Where have I got the iron ore price? There it is. Yeah, the iron ore price is interesting. It's gone from below the averages to above. The averages have crossed. We've had a couple of pullbacks towards the moving averages, and it rallies each time. It's is like, and look, it may not turn bullish. It might just then like it has done, just crisscross to the other side of the moving averages again and continue to do nothing. But it also could be like going through a basing phase, which is starting to gather momentum. So it's worth watching, and it's worth watching the price action that we see in the those big miners that are exposed to iron ore, Fortescue exclusively towards iron ore. So yeah, it's I think it's a stock with some potential. I'm happy to hold on to it. I think if someone's looking to buy it, like it's trading on its lows for the day at the moment. Maybe it's a case of saying, look, let's maybe buy a break. Like different ways to do it. We could buy a break above say above 220. Like see if it can like we've got this, looks like it's stepping high, but see if it can like step through 220. That could be the entry point. I'm probably not buying the pullback to the moving average. I'd like to see that momentum kick in, which hasn't quite kicked in yet. But yeah, certainly one to keep an eye on. I think we could get some upward movement in it.
All right. Now, you've probably answered this, actually, general question around commodities at the moment, but what would love to know your thoughts on this. When a sector like commodities is running hot, what's the smartest way to chase a fresh entry without chasing strength? Or what's the smartest way to take a fresh entry without chasing strength? It's quite a loaded question, but maybe you've answered it really in that last segment.
Well, it's yeah. Well, look, there's a potential opportunity with Fortescue on buying a breakout. It's like we looked at a silver stock. We looked at Sun Silver earlier. So Sun Silver is rallying off moving averages, but you can work out where it's just broken above a previous high, and so can I just quickly find it again? So a stock like Sun Silver, so you can see like you got this, it's like rally moving averages, rally. I could say, look, I want to get some exposure. So I could buy a stock like this, and I can 25% is it's reasonable. I could do that. I could take 25% of risk to see whether this is a developing trend. But then there are other stocks like this copper stock, for instance, which I know this one because I've got some of it. I spoke about this in my weekly strategy session several weeks ago when I was buying. But as for buying it now, well, where am I going to put a stop? Like it's the risk reward here is just doesn't work out for me. It's like I don't want to have a 40% stop to get back to the 50-day moving average. So some things I've just got to leave alone. It's Iluka was another example. Like it's running too hot now, but we had opportunities just only a few weeks ago when it was breaking out. Like Fortescue we're looking at now. It's a different part of the commodity sector, but looking for the consolidations, looking for the breakouts where risk reward looks favourable, and if there's nothing that looks favourable at the moment, well, that's just how it is. I don't want to chase something which is stretched above the moving averages. I don't want to buy something which is bombed out, just hoping it's going to come to life. It's it's got to have the right structure, and sometimes we've got to be patient and wait. If we miss some earlier opportunities, there'll be more opportunities in the future, but maybe we've got to be patient sometimes. But they're the ones I'd look for. Once we've had the consolidation and we're getting the rallies off the moving averages, I think that's probably where the best risk reward is at the moment. Something like Rio, BHP, Fortescue are probably candidates to keep an eye on. Being careful with the ones which have gone skyrocket.
Yeah, for sure. All right, last question here is, why do you use daily charts, Jason?
Well, there are all sorts of time frames we can look at. Weekly charts just move too slowly for me. I don't trade off the weekly charts. I might occasionally look at it if I want to get see a lot of price history, just to see where the current price is in the scheme of a longer term picture. But I don't make decisions really off the weekly charts, because one bar, 1 week, it takes a long time for anything to happen. When I was in my investment banking days, when I was on the trading desk, I'd look at things like currencies, and I'd look at them on I might look at a 5-minute chart. There's a 5-minute chart of the Aussie dollar. So when you're on the trading desk, you can trade that. That's a breakdown on a 5-minute chart. There's a tradable intraday move. I'm not doing that at the moment because I'm not. I'm looking. My focus is different. I'm looking for stocks for 1 to 3 years. I'm doing other things. I'm not sitting at my desk looking at 4 or 5-minute charts. Like, I've got the Aussie, I've got the Euro, I've got might have the gold price, I might have a bond price, and just looking at all these 5-minute moves. That was my job. That's what I did. But I don't do that now. So you can't trade everything. You can't trade every time frame. I think to a large extent, specialize in a strategy. Don't try and intraday is hard unless it's your full-time focus. So I don't look at the intraday now. I could look at you could look at you could be looking at like an hourly chart. That's probably it's somewhere in between. But for me, I'd prefer the daily chart. It's end of day data, less active. I can come here and do a video with Rog and talk to everyone for an hour and a half and not worry about what's happening on the 5-minute chart, because I'm not trading that time frame. Longer term positions, 1 to 3 years. I don't know what's happened the last hour and a half in my portfolio. It doesn't really matter. But if I had a whole lot of 5-minute positions on, I'd be a bit harder to do this.
Yeah, I think that's absolutely right. And I've certainly tried to do that myself. And I realized, geez, it's so much easier to do what we do and still grow the portfolio, right? Funnily enough,
the problem for me with the 5-minute charts is that much of the price action happens in the when we're asleep in the European and North American time zones. So it's like you look at like the gold price, for instance, and all the fun stuff happens when you're meant to be asleep. So when I was in my 20s, that was okay. I could stay up all night and do that. Don't have the tolerance for that anymore. So unless I pick up and move to the right time zone, it just ain't going to work for me anymore.
Yeah, for sure. I was just because obviously metals and commodities have had such a big run, and we had an example in there that wasn't in that sector as well. But I was just looking at I have quite a diverse portfolio, about 25 stocks now, 20 to 25 stocks. And if I look at the sector chart of my portfolio, in fact, metals and mining make up 54% of the portfolio now. So I found that actually quite interesting. I don't really look at that sector chart a lot, but you can see how much that commodity space is bringing up is bringing up the market here in Australia at the moment, right? So
it's interesting to be aware of, because we know that these stocks generally move as a pack. So yeah, if you get volatility, well, then you think, yeah, well, look, I am overweight that sector. So it's great when it's working, but you just got to be aware of it as well. That it can turn around also. So yeah, I think being aware of your sector exposures, it's probably a good thing. It's like, should you have 100%? You got a 30 stock portfolio and they're all gold stocks. It's like, well, yeah, that's you're asking for volatility. It's it's something to be aware of, Rog. Good point.
Something to be aware of. So if you're a Selfwealth client, you can go on your portfolio. I don't know if you know that, but you can actually just click the sectors button there, and you can see what a split of your holdings and what sectors they're held in, and you can see if you've got diversity or not, effectively. All right, I think that's it for this week, Jace. There's always a few more, but we're doing our best just to get to one from each before I draw the line in the sand, obviously. So. Don't forget, once again, to like and subscribe down there. Give us a comment at the end of it as well if you're still enjoying the show. We love having you here, so thank you for coming along. Thank you, Jason, for all your amazing analysis and knowledge and the time you give us each week. Much appreciated. Don't forget the exclusive offer for new viewers, new clients as well. That'll be all down in the descriptions once we finish the show as well, if you need more guidance on that. But otherwise, Jace, thanks. Thanks, mate.
Hey, Rog, that was great. Thank you, everyone, for joining us again. Lots of interesting stocks to have a look at. And, we'll come back next week and have another crack at it.
All right. Thank you, everybody, and have a great week. Take care. Bye-bye.